I'm Cramer. Other people want to make friends. I'm just trying to make you some money.
Hold on there, boy.
And you will want to own Coinbase for the long haul. This is a $475 stock. That's the upper end of what I'd be willing to pay for a large position.
This is a $475 stock.
Nope.
JP Morgan of this generation. Sam Bankman-Fried's FTX. And average fees per transaction across the industry had declined by 50%. A lot of that is the man, Sam Bankman-Fried, JP Morgan of this generation.
Son, you know how you become rich?
Yes, Dad. You work hard, save, avoid debt, create a business, and invest wisely.
Huh. No, you study Jim Cramer's stock selections very carefully. See what he buys. And you buy the exact opposite. That is a bulletproof strategy to make you very wealthy.
You're goddamn right.
Jim Cramer has had a rough history of predicting stocks. He's a stock picker and an investor, except not a very good one. You can kind of think of him like King Midas, except instead of everything that he touches turning to gold, everything that he touches turns to dust.
Peter writes, should I be worried about Bear Stearns in terms of liquidity and get my money out of there? No, no, no. Bear Stearns is fine. Do not take your money out. This is really, look, if there's one takeaway other than a plus 400 somewhere, Bear Stearns is not in trouble. I mean, if anything, they're more likely to be taken over. Don't move your money from Bear. That's just being silly.
Bear Stearns shares are down 90% this morning. JP Morgan, along with the Fed, was going to be bailing out Bear Stearns for $2 a share. This is a stock that recently was trading at 80. Last year was trading at 160.
After it comes public, listen, Tesla says sell, sell, sell. You don't want to own this stock. You don't want to lease it. Heck, you shouldn't even rent the darn thing.
You shouldn't even rent the darn thing. You shouldn't even rent the darn thing.
Every prediction this man makes seems to go wrong. The only logical conclusion that investors have come to, well, if I want to make money from Cramer's recommendations, I have to do the exact opposite. Thus the birth of Inverse Cramer. March the 1st, 2023, an ETF under the ticker symbol SJIM was made with the sole purpose of providing results that are the opposite of investments recommended by TV personality Jim Cramer. Normally an ETF is going long on someone's stock picks. DFAC goes long on stocks chosen by David Booth and his team with Dimensional. JEM goes long on emerging market shares picked out by the JP Morgan team. But SJIM shorts the stocks that Jim Cramer picks. Alongside Cathie Wood, Cramer infamously joins the unwanted list of investors who have inverse funds based on their positions. But where did it all go so wrong? How did Cramer become the laughing stock of the investing community, the antithetical stock picker of the 21st century? It all starts after he wound up his hedge fund and he decided to get into media. No, you didn't mishear me, you didn't have a mild stroke. Actually, maybe you did. Jim Cramer used to run his own hedge fund. And this hedge fund performed really well. In 1987, the great Cramer & Co. was born, a hedge fund created by Cramer which he claimed had a rate of return of 24% for 15 years, yielding an average of over $10 million per year. To put that into perspective, Warren Buffett has only achieved a 19.8% average return throughout his entire investing career. They say never ask a man if he's telling the truth, because a liar will tell you that he's telling the truth and an honest man will tell you the same thing. Whether Cramer was telling the truth, we don't know, as his performance was never independently verified, but when you look at the stocks that he said he was buying whilst running the fund, it doesn't make sense because all of these stocks turned out badly. In February 2000, he publicly stated that there were only 10 stocks that he wanted to own and he was buying them every day, quote for quote. These were the 10 stocks. Now, I couldn't find exactly what happened to 2 of these stocks, but here's what happened to the other 8. 724 Solutions fell from $325 a share to 83 cents. Ariba, once worth 40 bill, was acquired by SAP SE for $4.3 billion 12 years later. Exodus Communications had a market value of around $32 billion and then declared Chapter 11 bankruptcy in 2001. I'll save you the time, all of these 8 stocks basically collapsed. The only one that did okay was Verizon, which peaked at $240 a share in February 2000. collapsed, and then it would take 23 years to recover to the same stock price. So Cramer claims that he made an average return of 24%, but when you look at the stock picks that he said he was buying, they didn't end up great. If it wasn't his stock picking that delivered these results, he must have resorted to some other method.
You know, a lot of times when I was short at my hedge fund and I was positioned short, meaning I needed it down, I would create a level of activity beforehand that could drive the futures. It doesn't take much money. Now maybe you need 10 million in capital to knock this stuff down, but it's a fun game and it's a lucrative game, and I would encourage anyone who's in the hedge fund game to do it. But by the way, no one else in the world would ever admit that, but I can care.
That's right, and you can say that here.
I can't. I'm not going to say it on TV.
Jim Cramer is a man that loves to talk. I don't know a man who loves the sound of his own voice more than Cramer. And later on, he became more known for his fast-talking, entertaining investing show, as opposed to running a hedge fund. But in one of the smaller interviews that he did, his talking got him into a bit of trouble. He let it slip on the real ways that he and other hedge funds used to make money.
Now, you can't foment. That's a violation of
Ferment?
Yeah, you can't foment. You can't create yourself an impression that a stock's down. But you do it anyway because the SEC doesn't understand it. So that's the only sense that I would say this is illegal. So you would hit this guy and that guy, and when you would see an offering, when you see a guy who's bidding, you'd wipe out that guy very quickly. And what I used to do was called, if I wanted to go higher, I would take and bid, take and bid, take and bid. And if I wanted to go lower, I'd hit an offer, hit an offer, hit an offer. And I could get a stock like RIM for maybe, that might cost me 15, 20 million, Annie, to knock RIM down. But it would be fabulous because it would beleaguer all the moron longs.
This is a very smart yet obviously unethical way to make money. So if you're short on a stock, you attack it from every angle and you force it to go down. You can do this by a couple of methods, but the two that Cramer talked about were: one, you feed the media terrible news stories that the stock's business is in trouble and they're losing contracts and no one wants to do business with them, and any bad news that you can think of that sounds legit. And secondly, you create negative activity in the market and you put a bunch of short positions against the stock. The other players in the market will read the news and think, oh, okay, the stock is struggling. They'll read all of this bad news, and then they look at the trading activity and they see it's been highly shorted, that it's going down, so they sell and the stock decreases. And you, as the hedge fund or the big money manager, you can just sit back and make easy money while everything tumbles. This works great if you're a large hedge fund with a lot of money to move the market, but if you're a typical retail trader with the opposite position, good luck. That's all I can say.
It's really important to defeat research in motion and get the Pisani's of the world and the people talking about it as if there's something wrong with RIM. Then you would call the journal and you get the bozo reporter on research in motion and you would feed that there's a Palm's got a killer it's going to give away. These are all the things you must do on a day like today, and if you're not doing it, maybe you shouldn't be in the game. Okay.
Another stock that a lot of people are focused on right now seems to be Apple.
Yeah, Apple's very important to spread the rumor that that both Verizon and AT&T have decided they don't like the phone. Right. That's a very easy one to do because it's also, you want to spread the rumor that it's not going to be ready for Macworld. And this is very easy because the people who write about Apple want that story, and you can claim that it's credible because you spoke to someone at Apple, because Apple doesn't.
Right, they're not going to comment. They're not going to say.
So it's really an ideal short, and I think that's a very effective way to keep a stock down.
Right.
What's important when you're in that hedge fund mode is to not do anything remotely truthful, because the truth is so against your view that it's important to create a new truth, to develop a fiction.
And this is something that I kind of admire about Jim Cramer, was that at least he shared what was going on with the hedge funds. Even though it's obviously unethical because it means the market is not fair for the everyday person, at the very least he told us what was going on. I'm sure Cramer, he made a lot of money from these types of tactics whilst running the hedge fund, especially back in the day where it was a lot easier to do these things. Less independent news, less online detectives like CoffeeZilla. So maybe it is true that he got a return as high as 24% with his hedge fund, although not in the most honorable of ways. But in 2001, Jim Cramer decides to jump ship and he leaves the hedge fund industry. As stocks were shooting down from the great technology bubble collapse, Cramer makes his exit from managing Cramer & Co. Some argue not the greatest of time to exit your hedge fund when your clients need you the most, but Jim makes the decision that it's time to go. And this is where things get a little out of hand. Cramer decides that he wants to get into media. His stock picks and his investment ideas are too good to keep to a small group of people. They must be shared with the world. And in 2005, Cramer gets a job with CNBC and becomes host of Mad Money, a DIY investment show, which the more that you watch the show, the more you realize Mad Money is the perfect name for it.
So you could argue SVB's nearly 40% rally this year is barely a drop in the bucket. And that's how I want you to think it. These stocks could have more room to run. Being the banker to these immense pools of capital has always been a very good business. Stock's still cheap.
Stock's still cheap. Stock's still cheap.
The collapse of Silicon Valley Bank.
A rough week for the banking industry.
The collapse of Silicon Valley Bank. The second biggest bank collapse in U.S. history.
To me, it's reasonable to compare you, I usually don't do this, to Steve Jobs and what he did for computing. I regard you as a visionary, next generation person. To Steve Jobs.
To Steve Jobs. To Steve Jobs.
Now, you're talking about 1 billion people. You're talking about $100 per person. You're talking about market share take by Zuckerberg because he's simply unstoppable. People should be buying this stock.
People should be buying this stock.
Meta has officially plunged more than $700 billion.
I trusted this management team. That was ill-advised, and I apologize.
And the crazy thing was that after Cramer apologized for being wrong on Meta stock, it shot back up in price again. It seemed that whatever conclusion Cramer would come to, it just would go sour. And these picks and many more made Cramer the king of the investing meme world. Any bad investments or events put alongside Cramer to make it all the more hilarious. And from the outside it does seem funny. Here's this guy who can be so confident on an opinion, and the next week or the next month, everything goes completely the opposite way. Unfortunately, the joke for one man can be another man's pain. So anyone who knows a little bit about finance obviously knows not to take his advice seriously, but to the new investor, he can be quite dangerous and quite convincing.
I invested my entire retirement account into Cathie Wood's ARK innovation at the market peak because Jim Cramer and CNBC preached how she was the next Warren Buffett. I'm 59 and lost 80% of my money. I will never be able to retire now and haven't told my wife of 30 years about it.
Cramer's unabashed, oversharing opinions has unfortunately got a lot of viewers into financial trouble. This is the problem with Cramer. It's like watching a carnival ride for people who understand finance. It's funny listening to him. But to some regular Joe who stumbles upon CNBC, which is a popular show, he can get burnt very easy. Because Cramer takes one bit of information about a stock and he uses it to draw his entire conclusion, not acknowledging that a stock is influenced by hundreds of pieces of information. To truly understand the puzzle of a stock, you need to spend weeks studying the pieces and putting them together like Warren Buffett does. Unfortunately, this doesn't bode well with creating content for CNBC. Imagine a whole episode of Cramer talking through the financial statements, accounting, and intricacies of Intel stock, and this episode only comes out once a month. Boring. And thus you'll never see Cramer do it. And this is the reason why so many of his stock picks end up going wrong, because he doesn't have the time to study the full picture. But this also means he gets calls correct as well. Wait, we're in June, it can't be April Fools. Jim Cramer, accurate stock predictions? I thought those two were like war and peace, they're mutually exclusive. It's not possible. But yes, an accurate prediction out of Cramer's mouth might be the least thing that you expect, but I'm not joking, he has made some smart calls before. Cramer was bullish on Nvidia as early as 2017, then he took profits in 2018 before piling back in March 2019. Nvidia has done extremely well since Cramer's backing. Same year, 2017, he urged viewers, own Apple, don't trade it. In a way, he made it his catchphrase. Apple has gone up hundreds of percentage points since then, many people calling it the stock holding up the entire market. He showed good foresight with the Disney C-suite and correctly called the sacking of Disney's now ex-CEO 11 days before it happened. I know you thought it was impossible, but no, Cramer has made some correct calls before. And over the past 7 years, Cramer has made an incredible 21,653 stock picks, averaging close to 3,000 calls per year, more than 20 stock picks per episode. Whenever you make such a vast array of predictions on so many topics, some are going to go right and some will go completely astray. And that's what we see with Cramer.